Hi everyone, and welcome to this video where we'll be talking about the first learning objective of Module 5. Module 5 deals with the accounting cycle and reporting financial results. And so in this first learning objective, we'll be talking about making an income statement, making a statement of retained earnings, as well as making a balance sheet. So topics that you've seen before, but now we're going to go over them again now that we've learned the journal entry process and how to make T accounts and how to construct a trial balance. Now we're going to circle back and we're going to go through it all again to get some extra practice. So this stuff is a piece of cake. You're going to do great. Let's hop over to the computer. All right, so as I said, we're looking at the accounting cycle here, and we're talking about the financial statements. And as a reminder, before we get into this material, you can access all of this at my website, www.professoradams.org. Okay, so let's talk about this first learning objective here. The first learning objective deals with preparing an income statement, a statement of retained earnings, and a balance sheet. Now, an income statement is designed to show a user how much profit a company is making. It displays a company's revenue, its expenses, as well as its gains and losses. So revenue is the dollars that are being collected from customers, or if we allow the customers to pay later, it's what we will eventually collect from customers from selling something. So if we sell something out of a vending machine, let's say a bottle of Coca-Cola, and it costs $3 for the customer to buy it. The customer is paying us $3. That is our sales dollars. Well, how much did we pay to buy it from the supplier? Maybe we paid $1.50 to buy it from the supplier. So the $1.50 represents our expense, and the $3 represents our revenue, and our profit would be the difference between the two, or $1.50. Okay, so that's the idea here. Revenue is what we collect from the customer. Expenses are what we pay to deliver the product or service to the customer. And the difference between those two is what we're calling income, or net income in accounting language. So on your screen, you see an example here, and we're looking at Overnight Auto Service, and this is their income statement, and this is for the year December 31st, 2021. We're measuring the income for a 12-month period. An income statement is always capturing income, revenue, expense, income over a period of time. It's a little different than the balance sheet. The balance sheet says what were your assets, what were your liabilities, and what were what was your equity on a single day, on the last day of the year. What did you own, what did you owe, and what was left over for shareholders. The income statement, on the other hand, is saying during the period January 1st through December 31st, how many sales did you make, or what was the dollar value of your sales? What expenses did you have? So income statement is over a period of time, whereas the balance sheet is measured on a single day. Their statement of retained earnings is capturing the change in retained earnings that appears in the shareholders' equity section of the balance sheet. All right, so the idea with retained earnings is each year as we make income, we have two choices. We could either send that income back to the owners of the company through what we call a dividend, or as a company, we could hold on to that earnings so that we can reinvest them in the business. So retained earnings represents net income that we've made but have not yet given back to the shareholders. Okay, so each period we have to explain how retained earnings changed from last year to the current year. So that the idea of this statement of retained earnings is simply to explain how our retained earnings balance, which is a shareholders equity account, how that balance has changed. And as we've seen in prior lectures, the balance sheet is designed to capture what a company owes, what it owns. So I kind of did that out of order there. So what it owns, that's assets. What it owes, that's liabilities. And then what's left over for the owners of the company, sometimes called shareholders, sometimes called investors, that is all captured in stockholders' equity. So the way to think about this, if you have a transaction that relates to something you own, that's an asset transaction. If it's something that you owe, maybe you owe a bill or you paid off a previous loan that you've taken, that's a liability. And then any transactions with the investors or shareholders of the company, the owners of the company, those would be captured in equity. Things like the sale of stock to a new investor, or buying back shares from an investor that's already out there, or income that's generated that belongs to the owners of the company, retained earnings. These are all things that would fall into equity. All right, so that concludes our first lecture here in Module 5. I hope you found this helpful, and keep studying. You're going to do great. Take care.